Welcome to the Chaim Investment Advisors Podcast. I'm Victor Schramm, aka Chaim. I'm here with Pablo Lasha.
Yeah, I'm here, and we're going to talk about the stock market and inflation. But before we do that, I want to make a quick correction because in the last podcast, I said the U.S. GDP was 2.1 trillion, and it's closer to 21 trillion. And but my point was still relevant, which was like, how efficient is it to spend nearly $1 trillion to find money that doesn't exist? So stand by my point. I just wanted to make that correction. I was listening to the podcast, and I was like, yeah, probably being off by a factor of 10 is not great. So, but yeah, let's talk about the stock market and inflation.
Let's talk about stock market and inflation. Today, I actually got a new designation in annuities, and we're not even going to talk about annuities, which is kind of funny.
We should do an annuities one. Actually, that's true. I forgot to tell you about that too. Like, so you became a certified annuity specialist. Is that correct?
Yes, today.
That is awesome, man. Like you were actually, so when you were doing your thesis, you were telling me about your thesis, and you know what's funny is our last podcast was actually largely about what your thesis was on, which was about. You want to talk about it?
Yeah, so they gave me a fact pattern, and they said, basically make a thesis with this fact pattern. And I did it on split-funded annuities, which is our last episode. You can listen to it on YouTube, all about how can you replace an income investment with something that is not income investment that will become one later, and remain both a growth and an income-focused investor using annuities.
And I thought it was it's an awesome topic. When you talked about it, I did not know that was your thesis was on. So I thought that was really cool. So congratulations on the CAS, and that's awesome.
Yeah, so we're going to talk about a wholly unrelated topic, which is kind of funny, but it's about why inflation in stocks not necessarily the best relationship. And I think we should actually start with the argument that I was hearing over the last few months when people first started talking about, there might be inflation. There are a lot of people out there, even some people in the finance world, not as much. The finance world very much was scared of inflation, but didn't necessarily think it was going to happen. But the argument was, it'll be good for stocks to have higher inflation. Number one reason being that companies have the ability to pass on inflation to their customers in a way that no other investment can precisely, and that'll lead to them outperforming. So that was argument one, and argument two was that basically everything else will do badly, so people will buy stocks because bonds will do badly, real estate will do badly. I think it'll actually do okay. But this was the argument. It'll be the only game in town, and that means it'll be a really exciting game.
So I would like to address point number one. I think it's an interesting point. I wonder if you replaced inflation with taxes, if you would hear the same thing. Because the fact is that companies do have a great ability to pass on taxes to, the rest of to everyday citizens, right? But no one thinks that's a great idea because ultimately, here's a situation. This is a great example of sort of a misunderstanding of sort of financial illiteracy. Companies are owned by people, right? So it's people who do well and people who do poorly. And they do poorly or well, possibly through companies, right? They can do through a publicly traded company, or maybe they own their own business. But ultimately, it's people who are paying taxes and people who pay for the inflation. So the idea that it's somehow being passed on to people, but not to investors or not to the people who own the company is, I find it a little absurd. I mean, maybe they have some complex calculations, but I don't really see how that works. So.
It doesn't really work, and it's not. So that's a good argument around number one, and my argument around number two is that everything can do badly. It's important to highlight that because America tends to do really well, and we tend to have a really healthy economy. And we've had a few moments of unhealthy economy in the last, 50, 60 years. But really what tends to happen when an economy is unhealthy is pretty much everything does badly because capital markets cannot be really healthy when the economy is really unhealthy. They are, at the end of the day, too intrinsically linked.
Yeah, totally. I mean, it'd be straightforward. I find both those arguments.
Because to me, everything denominated in the dollar can do badly if the country is unhealthy, and the dollar is really what's unhealthy. And when you get high inflation, that's what that means.
And so, just to talk a little bit about why, because I heard a lot of people, people on both sides, people who don't like inflation, people who are okay with it. But why we have inflation, right? So, the idea behind the inflation, there's a couple ideas. One of the major ideas is that it gets people to invest. It makes it, so it gets people to invest is the best case scenario. But the other scenario is that it helps consumption, which is one of the reasons that people say, oh, well, high inflation, people will buy today, and consumption will go up. But the thing is, in high inflation, the higher it goes, the marginal returns are much, much lower.
Yes.
In the beginning, where it's kind of you're just getting everyone a little motivated. There's arguments to be made there that all right, so 1.5%, maybe even 2% being the ceiling. It's okay, there's always be made there that you're helping people to be motivated to invest or spend money to keep the economy going. So they're not just sitting around with money, right? And then the second thing, at least the second thing I always think of with inflation as the bonus, is that when you are at a company and you don't do well, it's unlikely that they're going to lower your wages, right? People don't like having their wages. They're just you lower my money, I'm just going to go somewhere else, right? So inflation is a way to sort of balance that out, So what happens at companies a lot of times is well, inflation happened and you didn't get a raise. It is kind of a decrease, but that's how productive they feel you are. And though that seems like a very strange thing for the Fed to focus on, it's sort of price elasticity is important to them, right? So that's really what they're focusing on. It just happens to deal with wages there. So those are the two arguments I've always heard. And I don't have any particular problem with it. The problem I have is this idea that I think we're going to discuss, which is that, well, the marginal returns are never diminishing. More inflation is better for the markets. I know that argument's not always being made exactly like that. It's being made indirectly. If you have a stock market where the real assets are not actually growing, but the prices are growing, that is inflation. So
yes,
that's kind of, I think, what we're going to discuss today. And I think I'm excited about it. So yeah.
Yeah. So that kind of covers what people think, why they thought, it might be good for stocks to have higher inflation. I tend to think it's bad for stocks, and the market historically has responded this way too. There's a lot of historical data to suggest that stocks do best when there's moderate to low inflation.
Right.
Moderately high inflation, so anything above the historical norm, is 3.25%. This is a really long-term historical norm for America. Anything higher than that, bad for stocks. And there is one reason I find very convincing, and it's probably, to my mind, the most widely accepted reason that I'm aware of, and that is how assets are priced. So it really gets into asset pricing theory, which we can actually explain. That don't turn off yet. It may sound like this is going to be super technical, but it's actually a little bit quicker to explain than you'd think. because what we're really talking about with repricing of assets, and that's what happens when the stock market goes down because of inflation. We have repricing assets. People are saying this isn't worth the price I thought it was yesterday.
Right.
Reason that happens is that the value of the earnings that they haven't earned yet goes down in the future. They say, well, the value of that dollar that they were going to earn next quarter is just not as high. So why should it be the price it is today? It should be lower.
Right. Yeah, no, that actually, we bring up now a compounded issue, because in this current environment, it seems like we're hearing about a lot of shortages. We have a labor market that is just confusing, to be honest, because it's really being subsidized right now, and so employers aren't able to really find an equilibrium to go out and pick up new employees, and so there's actually a real reduction. So sometimes we're talking about normative and real, just to, again, don't tune out yet, but like normative just being the idea of like what the number is, but real being the idea of like, well, what's the difference between that and inflation? What's the difference between that and the real value?
Yeah.
So we have like a reduction in actual, or not necessarily a reduction, but like not the growth that we have in the market. So it's like essentially a reduction in actual assets, right? And then we have the compounded problem, which Chaim brings up, which is that the inflation is also reducing the value of future cash flows. So now the difference between what the asset really is worth and what inflation is bringing it to is not only increasing, but the more it increases, the bigger the problem becomes, right?
Absolutely.
So,
and the really interesting thing in how assets are priced, that is oftentimes new information to people who don't spend their lives pricing assets. They're actually more based on what is going to be earned than what's being earned now. The way that you make a pricing model for an asset that doesn't have a lifetime, a stock lives forever. So we use this technical term, perpetuity. There's no like hard cap on this company's going to be wound down in 30 years. That may actually happen, but hypothetically, a company is forever on the stock market.
Well, and like just to jump in real quick with a little like trivia, oftentimes we did some podcasts on bonds and like sovereign debt. They don't issue perpetuities anymore for sovereign debt, but they did. And they still exist, actually. And so there is debt out there you can go buy, which pays 1% every year until I guess that empire crumbles.
Well, yeah, that's actually the origin of annuities. An annua was a perpetual. As long as you were alive, you got to make the claim, which gives the government a kind of a perverse incentive on your life when you think about it. But luckily we live, in modern times and not in past times. For that reason,
that could be a real issue. I know how to cut down on a lot of future obligations right now. Yeah. So it was a little funny for you guys, but I thought that was cool, and that was a cool idea, tying in those annuities. So yeah.
Well, yeah. So when the thing lasts forever, hypothetically on paper on a spreadsheet, the value of everything it hasn't earned yet is way heavier as a weight than everything that is earned to date. All that what it's earned to date tells you when you're doing a pricing model like that is it tells you what was the growth rate in the past. So it's priced into the growth rate. It's priced into, okay, what is the starting point from now? So we've got the growth rate and we've got the starting point, but really it's all of the money in the future that really matters. That's really what the price of any stock is all of those dollars it hasn't earned yet. And then it all gets discounted back to today dollars. And it's called discounted cash flow. There's tons of ways to do that. It's some version of that tends to be, one of the most popular ways of pricing things. So,
yeah, I mean, and like that is one of actually what I would think of as the introduction really to finance is understanding a present value and a future value and figuring out how you were going to discount that. Because what you need to do, right, when you're looking at different financial instruments is to be able to compare them.
yeah.
And they come in so many varieties. They have different rates of return. They have different risk profiles. They're just like they come in different denominations or different currencies. So there's all these different things that you have to look at. So what we're talking about here is sort of a core component, right? And so specifically here, I think we're just talking about the core component of like how we are evaluating stocks, and why inflation may not be good. And I think like it'd be good to give a little to give a little quiz here, where like let's say you were a government and you were issuing perpetuities, right?
Yeah.
So you did a ton of maybe to like build railroads or something like that, and you couldn't make people go away,
Yeah.
but you could print money, or you could, also take away money from the economy. What would you want to do in order to reduce your obligation, right?
To reduce your obligations?
Your future obligation for paying for the perpetuities. And in my opinion,
You want to make new money.
Exactly. You want to make new money.
Yeah.
And so as far as like, we're just thinking about pricing stocks and like whether or not inflation is good, if that's what you would do to reduce the value of the perpetuities that you own, would that be such a great idea then if you hold other stocks which have like future cash flows coming in perpetuity? You know what I'm saying? Like I think
Interesting question.
It's not exactly the same, but I think it's like a good little like thought experiment to think about. Like, well, obviously, to me, just at first glance, to me, it would not be good.
Yeah,
I see it as positive. So.
But there is so then the question always becomes that we say it's bad for stocks. It probably is. Just any way you can kind of reasonably price assets, your model starts to get really wobbly if you got an input that's really high for inflation. But aside from that, the question's always like, okay, well, but you got to have some stocks. Are some stocks going to do better than other stocks? Is there an area that's going to do a lot better that maybe it will be good for, and some that it won't be good for? And that's always the more difficult question, in my view, to answer.
Yeah, I mean, I think to me, again, just at first glance, it kind of comes back to the same thing, where I would expect that there might be a sector that does, performs a little bit better than other sectors when the inflation is on the higher side, but there's going to be a point where the return is not worth the risk, right?
Yeah.
And that point is not that high. When people talk about 4% inflation, there is no sector that's better off with 4% inflation.
No.
This is not like something, there's no sector that's like, so if we were thinking of like, the sort of critical point on the curve, we are past that at 4%.
Yeah.
We are not at the like, what's the efficient point of that curve when we are at 4%. So yeah, I mean, that's just like, that's sort of like that's my feeling. What do you think about that?
Yeah, because I think when you're in the zone of like, we're talking like 2.2 to 3.7%. Well, we're still talking about a zone where many companies can do incredibly well, and most will, right, in that zone. When you're above 4, it starts to be difficult to see who can really do well in the long run. You start to get into like, well, this is just kind of an unhealthy economy, and it has to get back on the right track more broadly to start supporting higher prices again. And that's, something that we could see as a result from having high-ish inflation. If it's really high, here's something that occasionally gets brought up in the inflation stock debate is Venezuela, which I'm sure YouTube is going to love us talking about Venezuela.
That's the crown and jewel of South America. I don't know why you have a problem with us talking about Venezuela.
Well, here's the thing about Venezuela is the stock market of Venezuela occasionally has had triple-digit annual returns.
Amazing.
It's come very close to 4-digit annual returns.
That's Bitcoin returns right there.
Yeah.
That's like, for those kind of, that's like the best performers in the world are not getting those kind of returns. So,
but the problem is that it is priced, that's only when it's priced in the local currency. And the local currency is doing a lot worse. It's doing
I thought this was all upside. I was ready to get my ticket and move to Venezuela. I thought it was
and so sometimes you've had multi-1,000% real return losses in a year where there's 3-4 figure percentage increases in the market. And so sometimes people will be like, well, look, in Venezuela, inflation's high and returns are incredibly high. But if you are losing money, you're losing money. In my view, I
would like to meet the people who think that, because that is, I have a lot of different things that I could sell them.
I've definitely seen this as an argument. It's an interesting one.
So there's another analogy I'd like to draw, which really just bring it home in case the Venezuela one, which I think for me was pretty clear cut and dry, but sometimes people have a little bit of problems understanding purchasing power parity and different types of currency. So let's say we just stuck with the dollar. And let's say whatever you're making right now, I'm going to triple it, but I'm going to quadruple your rent, and I'm going to quadruple food costs, and all your other costs are going to quadruple, but I'm going to triple your rent or whatever you're making. Do you think that you are better off or worse off? And it's pretty clear, if you've done any sort of fifth grade arithmetic, also multiplication, also anything like that, you could see clearly, right, that 3 times is not a greater factor as 4 times. And that's really essentially what's going on here. You know what I'm saying?
Yes.
It's the same thing in the Venezuelan economy. I have no doubt they were seeing triple digit returns. What I would like to know is about the prices of other things that you had to buy.
That's
was
when it
rent
gets scary.
Getting quadruple returns? Was food getting quintuple returns? You know what I'm saying? Because if that's the case, then I don't really care about triple returns. I will take a 1% return, right? As long as there's zero inflation every time over that. You know what I'm saying? Because you want to be on the positive side of the equation. Really, that's what it comes down to. So I think it's the same thing with the stock market and this inflation idea. People get excited because they say, "Oh, the stock market is going up, and look, it's the highest it's ever been, and there's no inflation." Okay, so there's two things I think I'd like to just dive into really quick. First is how inflation is measured. Anyone who's familiar with inflation probably has seen there's a couple different ways of measuring it. Often involves some sort of baskets of goods or services, and they say what was this worth at this time, and then what is it worth in the future. One of the problems or criticisms is this can easily be gauged, right? So you can look at other things, right? I think velocity is one that you and I talk about a lot. You get velocity, you can kind of measure inflation, right? But I think that there's this other factor that you can look at. You can look at the stock market priced in some other denomination. For instance, gold.
Yes.
Let's say you look at the stock market and you say, well, compared to gold, how much gold would it take, right? And
that is
granted, we are. It's always going to be influenced by whatever denomination you're looking at it. But the more views you can get, I think you and I agree on this. The more views you can get, the more robust the idea is, right?
Yes.
When you look at the stock market priced in gold, you do not see the same type of returns as we do when it's priced in dollars, you know?
That's true.
It's not that it's doing badly. I don't get me wrong. I'm not out here being like we have Venezuela type situation, right? But it is
No.
not the same. The enthusiasm would be much less if every day they priced it in gold.
Actually, this year it's worse if it's priced in silver than it has been in many years. Silver's up. I think it was up 78% the other day,
Yeah, that's huge.
year over year, which is incredible.
I remember you texting me that. I was just like, wow, this is off the charts. And so I think one of those things is that might actually be a cool idea one day for us to sort of look at historical returns in different denominations, because it kind of gives you a better idea of what's really going on. See, the problem when you are working with dollars, right? Especially now that, like, you know, even though you hear everyone say it's called the reserve currency, a lot of the reserve currency features are either missing or on the decline, right? I mean, people are looking at other places to put their money. And one of the reasons is because we have a printer that doesn't turn off. So, I mean, going back to that is inflation, right? That's not increasing value. I think that, like, you know, I don't know. I think we've driven it home in several ways. I mean, I'd be curious to see what people think about this, because, like, I think although evidence is overwhelming that inflation is not a good indicator or not a good you know, input for the economy or for stock markets. You know, so
yeah.
Yeah.
Well, now here is another question. Another question then gets asked often when I talk about this with people. Is deflation good for stocks then? And the answer is extremely no. It's like no in the absolute extreme. It's actually, catastrophic for stocks historically.
For everyone who's done calculus, and you know, maybe you've done a statistics class, and you've seen, you know, a curve, like a normal distribution. That's like basically a curve you'll see oftentimes in calculus. You know, a lot of things are like this, and what the curve represents a lot of times in calculus when you're looking at efficiency is that there is a sweet point between two extremes, and after those two extremes, or before those two extremes, you are in a really not great territory.
Yeah,
it gets worse dramatically very quickly, right? And this is, like, I think one of those things when we talk about inflation. There is sort of a sweet point. You know, you normally don't want inflation. I could see some instances where there's a correction and you just need to have it because you need to have it, right? And you try to minimize it. You know, you try to keep it. When we say we're like as close to 100 as possible, because it can get very, very bad after it goes below 100, right?
Yeah.
And one of the reasons is because of one of the things we talked about in the Guinness podcast. One of the reasons that they originally mandated, the Fed originally talked about inflation, the government was talking about inflation, and they experimented with inflation, was because they got people to go buy things. Like, if the price is going up, it's always going to be better for you to buy today. Well, it's the opposite is true for deflation, right?
Yes.
If the price is going down, well, why not wait till next week?
Yeah.
Be less.
My purchasing power is higher next week than it is this week. So why would I ever want to spend anything? People don't want to spend money in deflation, and that creates the pretty profound losses for corporations, because also corporations have overhead. And so the price of overhead is higher and revenue is lower. And so it gets very bad very fast in the opposite situation.
Because all of your fixed costs are now getting spread across lower amounts of products and services.
Yes.
That's exactly right. So now it's a bad situation to be in. And it compounds because you don't buy anything, your neighbor doesn't buy anything.
Yes.
And eventually someone has to be let go because they can't, continue to be employed, right? And that is like probably, I sort of like felt like we indirectly talked about that, but I don't think we explicitly say that. So when we say we want people to go consume things or buy things, people may think like, oh, well, this is just a consumerist attitude, and like, why would you want people to do this, invest money or purchase things? The major reason you want people to do that is because the deflationary spiral is really, really bad. And it's really difficult to get people out of the deflationary spiral. Because as anyone knows who's ever had a bad week or a bad month, that is like, once that feeling spreads, to your friends and everyone else, it becomes very hard to motivate people to go do things. I mean, at some point, you have reached a critical point where we're not talking about, how well your portfolio can do anymore. We're talking about how you can get out of the country because there's no longer a place you want to be in, And so it seems very dramatic to say, but it's true. If you go look at the history books and you find deflationary spirals, these economies are in shambles, and there's no one there to lead them out of shambles. And ultimately, as people, as individual economic actors, we don't actually care much about people making grandiose speeches. If deflation is happening at a rapid cycle around us, we're done. We're figuring ways to exit this situation, or we're figuring out new structures of hierarchy within those communities. Neither one of those things sound like promising things to me. So to avoid that, we like to have a little bit of inflation. So.
Before the Federal Reserve Bank, so there's a number of books out there on when money was metallic based in America, and before the Federal Reserve, there are actually a number of really bad deflationary shocks. There are a number of 20% deflation years in America, and when you look at what were people doing at that point, people were doing things like carrying around knives to shave off small amounts of silver from the coins to pocket because it was becoming more and more and more valuable all the time. They were finding ways to hang on to money in any way possible to not spend it. That's how severe it was. And then they weren't spending it, and we had actual just total lack of money supply. Like literally there weren't coins in circulation at various points.
We had bimetallism, right? We were actually on silver and gold standard, and I think it's funny actually. The movie The Wizard of Oz is supposedly some sort of satire about that. I read about it a little bit once. Historically, it's supposed to be like a satire where the Tin Man is like supposed to have some sort of silver, and this is probably very time or like that era appropriate. So like at that time, you would know what all the characters represented. But this is 100% true. And like when you have situations like where people are shaving off silver, I mean, if you think that crime and violence is not high, you are kidding yourself.
Yeah, so. It's bad for stocks. Deflation bad for stocks. High inflation bad for stocks. Medium inflation very good for stocks. Low medium inflation that's the comfort zone. As what some people would argue, as low as you can possibly get between inflation and deflation, like close to zero, is really the optimal point for high returns for stocks. But I tend to think, healthy real growth happens in the moderate zone when it's, 1.75% to maybe close to 3%. That's really probably when you get the best real actual growth in the stock market and the economy.
And I think that like some of the people make the argument that super low inflation or close to zero, they're making a secondary argument, which is that it's good for people, the common people. It's a very populist argument because it's good for people who hold debt when you have like a little bit less inflation. So there are different factors, but really I think what you and I agree on and want to drive home here is that regardless of whether you're like, hey, in that popular zone where you're like close to zero and the common man can pay down his debt, or you're in that other zone where you say like, hey, the common man can also invest in, the common woman can invest in the economy, and you see returns at like 2.5% or something like that. Regardless of that, if you get outside of that 0 to, I mean, for me, like I even like 3.25 is high. I'm almost like a 3% too. But, I am. We all have our own. We all have our own interests, right? But I think like if you get outside of that normal zone and you approach like 3.5%, 4%, you are in a dangerous place. So, and you get below that zone, you're in a dangerous place. In other words, it's a lot like the Earth, right? So we live in a nice Goldilocks zone here. but you don't
Yeah.
want to be too close to the sun, and you don't want to be too far away from the sun. And the idea that not only do you want to be close or farther away, but that you want to continue on that path is not necessarily the best idea. I don't know.
Yeah. So that's an introduction into why high inflation and also deflation bad for stocks, not really great for the equity asset class, unless you're also losing money effectively because you're in triple digit returns, but also quadruple digit losses of purchasing power.
And like just a little, sort of tag along note here. I've also heard people say, and like there may be arguments for or against different types of subsidies or wage increases. I've heard people say, like, look, if you increase minimum wage, you're increasing demand. Well, it's the exact same argument because that has to come from somewhere. You can't get something from nothing. I think there was a song they had like in the 60s or 70s, right? And from nothing is nothing, or is that what it goes? I don't remember. I kind of just remember in my head. But you can't get something from nothing, right? So it's not like you can raise minimum wage. You are almost certain to have like not even nearly the effect that other things do, but you're almost certain to have an increase in inflation, and you're not
Absolutely,
creating more demand out of thin air. Demand, it just comes from demand. Like the demand schedules are like, it's not like appropriate to say they're infinite, but it's appropriate to say that like since there's almost a usefulness or productivity to everything, that there is always some demand for it, right? It's just more a prioritization of that. And so yeah, like when people will say like, oh well, if you raise minimum wage, it's like great for companies too. It doesn't take into account that like, yes, also those companies have to pay the higher wage, So this is kind of like the similar argument, like, oh well, if we like introduce inflation, oh look at the demand for stocks just increase. Look at it, it's great. It's like, well, yes, but then there's also the counterintuitive effect of like future cash flows, and also just the fact that like the inflation is just bad for. Inflation is bad for cash flows. That's like the argument I get from our conversation right now. Like we talk about so many different things, and never once have we seen an example where cash flows were better off with high inflation. So
Yeah, no, it's impossible for that to happen. And we've also never, one very interesting thing, we're in a new territory with such high inflation with such an old population. America is much older than it has ever been on average. And there's currently no new wave of kids. Millennials are having fewer kids than any previous generation by far. And so that's the interesting thing. You have high inflation and a lot of people who will never be productive again economically in the same way. They are not in the productive, goods producing, service producing class. And so it's going to be very odd. You have a lot of people who just live off of cash flows from investments or Social Security and inflation. It's going to probably look a little bit different from the historical frames that we can compare this to otherwise. In my view, that's something that I haven't really heard talked about, but it makes sense to me just from the clients we work with and what I know about people's situations versus the economy at large. This is going to be kind of a weird time for that. And my hope is that this is, as they say, transitory. Everybody keeps using that word that means brief. That's the hope, that there are some very brief in duration reasons for this to be happening, and they'll go back to normal.
That is a very optimistic point of view that I would also like to see. I also thought it'd be cool to point out something. We have a lot of podcast ideas, and we write them down. So sometimes we don't talk about ones we'll mention a topic, but we do have it written down. We have a lot of topics. We will get to all of them. But one of the things you brought up, I think, which is something we probably should talk about in the future is demographics.
Yeah.
Because people looking at this new global economy, in order to better understand their own financial futures, really should understand demographics, right? You talked about one of the major components or major demographics that people break down is the older class of people who are less productive or more likely to be retiring. That has a huge effect on the economy, right?
Yes.
And, you only get more productivity from technology or people. Right?
Yeah.
So if the next generation of people is as the same or less, then you need to have technology to make up for that. Luckily, we live in America. We are probably one of the most robust in terms of inventing new things, inventing new technologies, being creative. Something I hope that we maintain, that we don't get rid of, because one of the things that made us the most successful. But yeah, the demographic is changing, and that's important. A lot of things, a lot of different policies we have cannot hold up in a new demographic.
Yeah. And that's
Yeah.
that's probably the most troubling thing to me about America now and higher than average inflation. Is it's not exactly going to be affordable for most people in the way that it was before.
Right, 100%. I think that's touched on your topic there. This is not. We're not even talking about sort of criminalize political opinions. We're really economic and finance people. We're just talking about math.
Yeah.
Math is pretty clear. Math is hard to argue with. Either the math is right or it's wrong, and the math is not good in terms of. In fact, for a lot of countries, the math is not good in terms of demographics. And these new regimes of inflation, or those people who have decided to have negative interest rates, or these sort of what are really experiments, which are dangerous experiments to be doing when you have such huge demographic shifts. So
well, yeah, and that's one of those things where people like you or I, what we do and what we're interested in the numbers, it actually kind of insulates us from being more ideological and more political. It makes you a lot less political when you are looking at outcomes, and that's what you care about. And you care about, okay, what is the outcome from this? And you actually are responsible for other people, responsible for a lot of people's actual money.
Yeah, and
literally our jobs here.
What we like to in economics call it the moral hazard is not a factor, because, like you say, in our lives, our livelihood is dependent on doing a good job, on performing well, right? So if we, are giving people bad advice, or we're not performing well, I think anyone listening would say, yeah, if you lost my money out, any amount of my money, even a small percentage, I would be like, what the hell? If you were you said this money was going to be here for this retirement and it didn't go that well, I would have questions. People have questions now, and I think that we do a great job. So, which they should have questions, but nonetheless, people are very sensitive, right? And they should be. But the thing is, like you say, when you have this, when your job is set up this way, you have an incentive to only get results, right? Not to be oriented around. We really it's not really important who's doing what. It's important what kind of performance we can give. So and so
we have to maneuver around it no matter what it is.
Exactly.
We just have to whatever the status quo is.
Taking our calls.
Yeah, we just have to do the best no matter what the policy is. It's not really, my place to say, oh, the policy is wrong. What's interesting is, okay, this is the policy. How do we make money? That's how my brain works.
What's going to happen in this policy? What kind of hurdles do we have? Or places, what kind of successes? Here's a place where it's going to be a lot easier to move forward. Right? And so, this podcast really just I think to sort of educate people a little about stock market inflation, and to sort of talk about, I do think that'd be a great podcast to talk about demographics in general. We could tie in with just demographics in general. The way demographics are going to shift countries is really, really important in understanding what kind of economies will be successful.
That's right such
a bat. Yeah. I can just think of China. I'm sure you've thought of this.
Oh yeah.
They have when you have demographics that they're not completely inversed, but but are not like where you would like them to be in terms of growth. It's something to be aware of, right?
Well, yeah. So demographics, interest rates, and inflation, all three are inextricably linked. In the Federal Reserve, uh, they commissioned this great research paper. It's about 70 pages long. It lives on the website of the Federal Reserve Bank. I believe it's on the St. Louis Fed's page, which is actually a great investor resource. Fred is the name of it. Fred's where.
I love that. That's like one of my, I'll be honest, like it took me a while to realize if anyone else had if any of the other banks had their own webpage, because I would just always go there because it has like, the basic graphs you look at like for money supply and different money supplies and different velocities and different money supplies. So different
Yeah.
and stuff. They have a lot of great.
I love that site. Yeah, no, I look at that all the time. But there's a great research paper that should be a topic of conversation. The argument there is that the three things are always in tension a little bit, but they're all moving on the same trend. Really, they have to be in the long run. Any divergence always reverts to the mean of what are the other two doing. So you get bad demographics, you get low interest rates. Look at Japan, look at Denmark, look at Russia. You also have low inflation. We've done something in a short-term way to deal with COVID that has made inflation look one way, but this is my closing remark is people will ask, oh my gosh, is this forever? And is this like, do you really think this will go on forever? I say no. I say actually probably deflation personally. I think that's actually the destiny, deflation, not inflation.
Yeah, if I'm looking at like we talked about last podcast, we talked about business cycles. One thing like business cycles, I'm thinking the next business cycle we're looking at deflation, because not only because of those things you just discussed, but because of the way that inflation was implemented. So it was not implemented on an equilibrium that was in concert with those other two things, with like interest rates and demographics. Interest rates and demographics, like you said, were moving in other directions, and our policies refuse to acknowledge it. And again, as much as we work around the policies of the state and the government and the government works around the real world math and data. Like that is the hierarchy. They cannot avoid that, right? And so this is the issue. That's what people say, it's good or bad or whatever. Like things that unexplained that happen in economies. The bottom line is the real world, math and the real data suggests something else than the what I hear commonly in conversations, right? And I think that I think deflation is probably like, again, not to like scare people like that it's going to be that we all need to walk around with knives and like shave off corners. Maybe not talking about deflationary spiral, but we are talking about there being deflation.
Yeah, because some people say, "Oh, are we going to be like Zimbabwe or Nigeria or some of these places?" And well, in Nigeria, it's an industrialized country where the average person is 15 years old.
Right.
There are so many kids per family. It's very common to have 6 kids. And that's absolutely no diss on Nigeria. I think Nigeria very bullish on in a lot of ways that other advisors are like freaked out by. No, I think if that's where you're at, that's a really interesting situation.
Emerging markets, I think I'm just very bullish on in general, just because
you have to be at this point.
Where would the marginal retearns be that we've seen historically in the developed economies? Well, we're not going to get them here because after a while, people they become satiated. They're like, I've got a nice place to live. I take care of my kids. They're going to college. I don't have this incessant drive. Not everyone is going to be I don't know, Jamie Dimon from from Chase Bank. I need to reach the top, whatever it is. So, again, we're talking about like factors that are like common across different economies. Like in those developing places, people have a drive to want to get nice homes, to want to live in nice communities, to want to educate their families and have a legacy of wealth. So yeah, there's, in my opinion, like the real question is like, how, I think this is another great topic, is like how one day that, investors in America might be able to invest capital there.
Yeah.
Obviously, I think in a lot of those countries, there's a lot of concern because in the past, they may feel like, developed countries have taken advantage of them. So as they develop their own capital markets, sometimes this happens in countries we already or have good relations with, where they'll be like, yeah, very strict rules around investing capital in those countries.
Yeah.
So
makes sense, really.
Yeah, exactly. Yeah, you're not going to come and take our cheese, right? So,
yeah, we've done plenty of that. But yeah, so that's my thought on that, is that a lot of those countries that have experienced high long-term inflation also have booming populations, very young populations. You have every single year, a large share of your entire population coming on to the market as new wage earners every single. That's not true in America. That's not going to be. It's not going to be true in the next 30 years. It just is not.
And as we were talking about, again, looking at the data, the fact is, this is true for like some European countries. Regardless of your politics, if you want to continue to be competitive, you will have to have immigration, not just because you want innovation, not just because you want to draw talent, but because you need to replace a birth rate that's less than the replacing population, right? So now, I think in America, it's like 1.7. So that means for every 2 people, it's 1.7. If you want to have an economy, especially when you have, sort of policies like Social Security, if you don't want to see that collapse around everyone, right, you need to have more people. Although I don't think that's necessarily a great long-term solution, again, because it's not good math. But that's just a fact. And it's true for those European countries, which some of those European countries, their nominative interest rates are positive, but their real interest rates are negative, right? So they're actually in and
some have nominal negative interest rates,
which is really something else. Where you're just like, like I don't know. We did I think we just talked about it, and then you wrote an article.
We've talked about it. I've actually written for publications before. That was one article I had that was published a while ago. Was about what it really means to have negative interest rates.
Right. Well, yeah. That's just it's insane. So a changing economy. Obviously, the world getting more globalized. These are just interesting things to talk about. I think we probably, if you listen to this podcast still, you probably learned a little bit more than you just, you originally started out with the stock market and inflation. But they are really cool ideas, and they are really all intertwined. Oftentimes you hear us talking about the same topics, sort of, or closely aligned topics. And the reason is they're really intertwined, especially when we talk about demographics.
Yeah.
To the real interest rate and where inflation would be, especially like without any sort of intervention by a central bank, right? I mean, we see how closely they're related, And so, if you guys like have any interest in some other topics, or sometimes we get super technical.
Inflation is one that people have mentioned. They want to hear about inflation.
I think we should do an actual just
straight up what is inflation?
It's a good question, because I have had many conversations with people who told me they knew what inflation was, and then when I explained to them, they would be like, well, that's not inflation. But I would show them with analogies of I use pencils and erasers, of how this was actually inflation. And people are always surprised, And I think that it's very one of those things that's very politicized. And it's not good to be oftentimes when things are politicized, because it's just obscuring the truth. You don't need a narrative. People need to know what actual inflation is.
Well, because within the inflation debate, in my opinion, a lot of it's people are arguing about marginal factors. Like the most inflation is here, and it's just what we all do every day, and what the government incentivizes us to be doing on a regular basis. This is mostly inflation. And then people talk about this. They talk about the outer rim of inflation and have super strong opinions about that. And I don't tend to have as strong opinions because I tend to be more of like, okay, what in this middle, like 95%, what is going on? That's what I'm particularly interested in.
And the concept is a pretty robust concept. So it's not like that, I don't think it's as ambiguous as people think it is. I think what happens though is that the concept of money is very vague sometimes to people. And like, oh, what is money? And like, when is it money? Is my cryptocurrency money? And I think that like talking about inflation will actually shed more light on like a little bit more about like the value of money and like.
Yeah, people really liked our talks about money before. We've done what is money, introduction to like where does money come from. I think that's one of the more listened to podcasts and definitely most talked about podcasts we've done. So yeah, adding to that will be good.
One of the things that I probably had the most debates about is oftentimes people would tell me they would want to go back to a trading economy. But you do realize all the things that would disappear if you have no way to store your value over time, right? And like, even if you could store your value in like, say, wheat bundles, like, first of all, it has a duration on it. Second of all, how are you going to move these wheat bundles? You know what I'm saying?
Oh yeah,
it's just not as great at all. As money has created poets and artists and the times for people to like build technology. And that's really what it is. It allows us to do all the things that we would do with trading, but more robustly in the sort of legal fiction, if you will. So yeah. But yeah, I would not. Anyway, on that note, I think I'm done talking because I'm like, once I have to defend money. But yeah, I appreciate this is an awesome conversation. I want to definitely talk more about demographics and inflation because I know it's a topic that you are really knowledgeable on, and I love having a conversation with you about that. So we should definitely do that.
Yeah, no, that's one I've always been fascinated by is demographics and inflation and inflation in general. I've always been interested in, but that one was, I think, when I became an investor, is really when people. I happened to start getting really involved. At the time, people were dissecting Japan. Why is Japan such a failure as a systemic economy? Why is it really messed up? And this was a really influential debate at that time. And people have stopped having as much inquiry around it in recent times. But it's still super relevant because a lot of those demographic trends people were very troubled by, they have accelerated very fast and spread all over the world very fast.
Yeah, Japan was definitely the canary in the coal mine there.
Yeah.
That I don't think that a lot of, at that time when that whole process started, Europe was in the midst of trying to compete for reserve currency status. And they had a whole different list of problems after that happened. So. Yeah,
that came off the rails really fast. And it was demographics to a very large extent. That's anyway, a topic for another podcast. But for now, I think we've covered a number of inflation and equity topics. And so going to go feed the hungry baby, Amira. She's 11 months old and patient, but there's a limitation to that.
As a patient as a 11-month-old baby.
Right? Yeah. Oh, she is a great 11-month-old, but there's still, she needs to eat. Cool. Well, this has been great. And next time, maybe we'll talk about annuities. We'll talk about movies at some point more because that'll be fun. We have lots to talk about, but for now, this has been the Chaim Investment Advisors Podcast. I'm Chaim Victor Schramm.
And I'm Pablo Lasha.
And y'all have a good Shavuot. If you celebrate that's this weekend, and have a great weekend in general.
Sounds good.